Might come out. Okay, let's do it.
Good evening, Gauchos. I'm Tristan Fosgate, Professional Engagement Manager at Alumni Affairs. On behalf of UC Santa Barbara alumni, I want to thank everyone for joining us this evening for the May edition of Gaucho Academy, presented by American Pacific Mortgage. This webinar series features keynote speakers and expert panelists who delve into topics relevant to our Gaucho community. And I am delighted to introduce Jason Mata, who will be leading tonight's home buying workshop. Um, Take it away, Jason.
All right. Thank you so much, Tristan. Appreciate
Yeah.
it. And it's great to be with the Gaucho community today. Yeah, this is a class that we provide usually 4 times a year. So this is the second installment of our Homebuyer Workshop series. So in case you missed out on tonight's class, we'll have 2 more opportunities to join here this year. We do understand everybody's pretty busy this week with graduations and 3-day weekend and all that stuff. But we are recording tonight's class. So, if you can't get a chance to tune in tonight, that's okay. You'll get a chance to see this up on our YouTube channel tomorrow. You can check out all of the great content. Like I said, this is a class that we provide 4 times a year. Really happy to and feel grateful to partner with the UCSB Alumni Association. And so, it's something that we get a chance to do to just help invest education into our local communities. My name is Jason Made, as Tristan mentioned. I work for an organization called American Pacific Mortgage. We're the 9th largest lender in the country. And our team is privileged to be the #1 producing team within American Pacific Mortgage. And we get a chance to serve our communities through our educational platform. So beyond our UCSB partnership, we also have 15 other alumni associations we work with all across the country. So whether you're in California or Texas or Florida, we can support you on the home buying journey. So we get a chance to connect with our local communities through classes like this. So tonight is a very interactive session. So if you have questions as we go through tonight's content, feel free to just drop those in the chat or the Q&A, and then myself and my colleague Ken will be answering some of those questions. And then we'll carve out some time later on before we wrap up tonight's class to answer any follow-up questions that our audience might have. And this class is being recorded, so like I said, if you need to step away for a second, they'll be up on our YouTube channel. We're also going to go ahead and send you out the presentation material. So I know we had quite a few people sign up for tonight's class. We'll send all the presentation material out to you tomorrow morning as well. So let's kind of dive in. Let's talk a little bit about our discussion points for this evening. So we're going to spend some time talking a little bit about what's going on with the housing market, a lot to dive into from that perspective. Also spend some time looking at what the interest rate environment looks like for us as future first-time home buyers. And we're also going to talk a little bit about budgeting for home ownership. So as we're considering home ownership, as we're comparing what I'm paying today for rent, what does that look like if I decide to transition to home ownership? So we're going to walk you through some calculations of that, and ultimately, kind of, does buying make sense for me in a consideration of a financial investment? We're also going to talk a little bit about credit, how to prepare myself in the buying process for credit. What are some tips that I need to know around improving my credit potentially, or just areas of opportunity? Talk a little bit about loan programs that are available to us as first-time buyers. And then we're going to kind of talk a little bit about how do we save for home ownership. So when we look at some of the challenges around just affordability in our markets, savings can be a bigger challenge for some clients. So I'm going to walk you through a savings plan exercise. We'll also talk a little bit about first-time home buyer programs. So for those of you that may be considering buying in California, there are some wonderful first-time buyer programs here available in California. But if you're not even buying in California, there's also first-time buyer programs all across the country that are designed to support low to moderate income first-time buyers. We'll also try to walk through the buying process. So after tonight's class, you may be thinking about, hey, I want to build a plan for myself for home ownership and set some goals for myself. We're going to walk you through the buying process and what that might look like. All right. So that's kind of a little bit of our look for tonight. Again, this is a very interactive class. We want to have discussions with our class. And so, if you do have some questions, just drop those in the Q&A or the chat, and then I'll make sure to get those answered on air for us. Okay. All right, let's go ahead and dive in. And, I want to first kind of talk a little bit about, does buying make sense? Because ultimately, this is probably going to be one of the biggest financial decisions any of our first-time buyers is going to make. So obviously, when you take time out of your Thursday nights in a busy, maybe hectic week for you, you're obviously understanding the importance of making a great, sound financial decision. And when we think about buying, there's a lot of great benefits that come along with it, like affordability, maybe improvements, because no longer do I have to worry about my rent increasing on a monthly basis, or an annual basis, I should say, as I renew my lease. Some buyers that choose to buy in today's market, while we're at, elevated interest rate levels, there still will be opportunities to refinance at some point in time when rates start to normalize. That improves cash flow and, of course, affordability for our homeowners at that time. Now, this is an asset that should generally grow over time. And so as we think about what we buy our home for, that home value is going to go up from that point, hopefully, right? And as I pay down my balance, the difference between what my home is worth and what I owe on my home creates home equity. For most people across the United States, that's their number one asset, right? And so for a lot of us in California, that is truly the number one. And it does create an opportunity to pass along that asset to heirs of our state and really potentially create generational wealth for most families. Now, there can also be some tax benefits that come along with owning a home, the potential deductibility of interest, as well as some tax benefits that could come along with maybe energy efficient improvements that I make to my home. So a lot of great things to think about when we consider home ownership. So I would encourage our classes that when we consider our budget for home ownership versus what we look like from a rental perspective today, it's really not fair to call it maybe an apples to apples comparison, because a lot of great benefits come out of ownership that we don't realize when it comes to renting, right? Now, to illustrate that point, I want to walk us through a calculator just to better understand what does it look like if I just continue to go down the path of renting today versus what could it look like if I decide to own. So I'm going to go ahead and drop into this calculator. It's a rent versus buying calculator. Again, in case you missed it, we're going to send out all this presentation material to you tomorrow. And I would encourage you, if you have some time, do your own kind of walkthrough on what this calculator looks like. And so we're going to first of all, and by the way, we've pre-filled all this stuff out here for tonight just to keep us on track. But if we look at the first section, this is our rental section. So we assume a client's paying $3,000 a month in rent. We have monthly renter's insurance cost at $15. And then we have the assumption that rent will rise 3% on an annual basis, okay? Then we open up the home purchase tab. We assume a $650,000 purchase, that our minimum down payment, which we'll talk more about in our program segment, is 3% on a conventional loan. We have property taxes for my home, homeowner's insurance costs, as well as the maintenance costs for my home. And then we'll open up the loan informations tab. So in that tab, we assume that we're going to do a 30-year fixed mortgage, which we'll talk more about in products. But we look at the average interest rate, which we'll spend some more time looking at interest rates, but let's assume 6.875 for our discussion today. And then we have origination charges. So when we think about origination charges, those are the costs that a lender is going to charge you for obtaining financing from them. Now, with our partnership with the UCSB Alumni Association, we actually discount our origination cost by $750 to create better affordability for our clients that we work through the association. So that'll give you some discounts in building your home buying plan. Now, this next section is called discount points. What discount points are is when a buyer decides to pay more funds out of pocket in order to bring down my interest rate. A point is usually 1% of my loan amount. And that 1% that I pay out of pocket, so if I finance $600,000 and I pay 1 point, that cost is $6,000. That generally translates to about a 0.25% reduction in interest rate. All right. And then we have other settlement services when we think about the equation for buying, which would include title and escrow fees, maybe some of the local municipality fees like transfer taxes for your county or city. So those all get baked into what we call is closing costs. Now, generally speaking, when we consider home ownership, closing costs are going to be somewhere around 2 to 3% of our total purchase price. Last tab is this other assumptions tab. We assume that our home will appreciate by about 4% on an annual basis, that I'm going to be in my home for the next 7 years. I'm going to sell my home at the end of 7 years. So what's the cost of doing that? What the state and federal tax rates look like for me locally. And then I also want to bake into the equation what my savings rate comparison could be. So when we look at this scenario, we have, first of all, we have a rent payment that we know of. It's at $3,000 a month. If I'm going to transition to home ownership, obviously my rent or my budget's going to increase quite a bit, right? So now it takes me to basically about $5,600 a month. So a $2,600 increase in outgo. However, the thing that we want to factor into our opportunity cost is going to be, what does it look like over those next 7 years by owning my house versus renting? So if I bake in my tax deductibility benefits, the potential 4% appreciation on my home, I have about a $61,000 opportunity of owning a home for the next 7 years versus renting my current place, right? And so that's kind of the approach that we take to considering home ownership. Now, everybody's situation looks a little bit different, but we would encourage you to dive into that calculator. That's a great tool to kind of help frame up for you the differences between doing what we have today versus what it could look like in ownership. But again, this is a big financial decision. So doing some of that investigative work and understanding those resources will be super helpful for you. Now, as we consider entering the home buying market, we have to take a look about what's going on in the housing market, right? And so I want to give you kind of a snapshot at the California housing market and kind of give you some commentary on overall what's going on in the housing market. Now, today we're in the spring buying months, so it's generally pretty active right now. Now, in other parts of the country, not like California, but other parts of the country are now seeing warmer weather, right? And so you'll see more buyers get active in the market. You'll see more sellers putting their homes on the market. So activity levels certainly pick up, and that'll also continue into the summer season, mainly because people are trying to look at purchasing maybe a certain location, neighborhood, because of maybe a school district or a job promotion or just an overall more desirable community that they want to move to, right? So we do see a lot more activity in the markets. What's interesting in today's market, we are seeing some shifts when it comes to inventory levels. Homes are staying on the market longer. And so we're seeing this kind of backup of inventory. So across California, you're seeing, homes are staying on the market over a month, but that's taken in consideration all of California. Some areas of California, you're seeing homes stay on the market 40 to 50 days. And so that's not something we've experienced at all. In fact, nationwide, we had a 0.1% price decline this month, which is the first decline we've seen in prices since 2019. So there is some changes happening in the market. Now, it could be just around maybe uncertainty in the local economy. It can be, more sellers are saying, hey, I'm ready to get out and put their homes on the market, but maybe there's just not the buyer demand because of interest rates. But I do think at the same time, with increases in inventory, do create better opportunities for buyers in today's market, especially from a negotiating perspective, whether that's to reduce price, potential concessions from the seller to help with things like closing costs. There's a lot of great opportunities that come out of increases in inventory. Now, if you're not considering California, other states like Florida, Texas, Colorado, Georgia have some of the highest inventory or supply numbers across the country. Now, as we move further throughout this year, we probably will see more homes come on market. The question of the activity levels for buyers towards those properties will be driven around what's going on with interest rates. Now, today we're on, elevated interest rate levels, and, part of that is driven off of what we're seeing from just an inflationary levels across our economy. Now, we do face it as consumers, right? So we feel that cost of things just being more, whether it's going in and fueling up our cars, whether that's going to the grocery store, all those things, we feel that from a cost perspective. The reason why, we see elevated interest rates is because the Federal Reserve is trying to lower inflationary costs by raising rates. Now, the inflation goal for the Federal Reserve is 2%. Today, we're right around 2.5 to 2%, 2.6%, depending on the reading you get. The other mandate by the Federal Reserve is to have a strong labor markets. And so, we're seeing some pickup in the labor markets, although, there still remains to be seen what's kind of underneath all that. Inflation is showing improvement, but not to the signs where the Federal Reserve is giving an indication that they're going to cut rates at next month's meeting. Now, when the Federal Reserve does cut rates, that can have a ripple effect in mortgage rates. It won't correlate to a 1-to-1 ratio for rates reducing, but you will see reductions in personal loans, credit cards, auto financing. That will help with any type of Federal Reserve rate reduction. Now, when we look at rates over the last 12 months, it's been a really bumpy ride for us. The lowest levels we've seen for 2025 occurred about 5 weeks ago. That dropped rates to about 6.3, but they've slowly kind of crept back up. And so just a lot of uncertainty in today's market around, are we having tariffs? Are there not? Right now, we're in a 90-day pause on tariffs. We're looking at the federal or the U.S. debt that was just recently downgraded, which that had an impact on what's going on with interest rates. So it's a really choppy market that we're navigating right now. But I do think while there remains volatility in the interest rate market, there can be opportunities for buyers that are financially ready to enter today's market. So with stronger inventory levels that we haven't seen for at least the last couple of years, and interest rates that aren't at the highest level we've seen in the last couple of years, there can be some areas of opportunity for buyers. Last thing I wanted to kind of spotlight here is, what's interesting is when you look at today's interest rates and you kind of span over here to 20 years ago, very similar interest rates that we saw 20 years ago. Now, home prices were a fraction of what we see today, but at the same time, we're not too far off of what we saw in past history. Last thing I want to just comment on is you can see this gray bar here. You can also see this other gray bar here. So this one here represents the housing crisis of 2008, 2009, which, is not as relevant today, but certainly what happened in the pandemic levels where we saw interest rates drop to the lowest historical levels. That was obviously certainly relevant. What occurred at that time, a lot of existing homeowners were refinancing their homes to get lower rates. Buyers that could afford to purchase were purchasing at lower rates. The question I get from a lot of clients across the country is like, when are we going to return to 2.5% and 3% interest rate levels? The reality is we hopefully will not get back to those levels because that means something catastrophic has happened across the country or even globally. But certainly when we think about average interest rates, we're thinking more around the high fours, 5, maybe 5.5% level. Okay. Now, all interest rates are not the same for all buyers. So I think that's important to understand. Credit score and eligibility plays a role, the type of loan program that I'm going to select, how much I decide to finance, what my down payment looks like. Even discount points, which we talked about earlier, can help invest into bringing down that interest rate. However, at the same time, I don't recommend clients in today's market, at least, paying points unless they really have to, because there's about a 3 to 4 year break even on those type of investments. And then finally, the loan term can also help lower the cost of my interest rate, because if I shrink from a 30-year loan down to maybe a 15-year loan, that generally will give me a lower interest rate option. Now, you're going to hear me talk a little bit about consultations tonight, where I do one-on-one sessions with clients to design their home buying plans. And during those sessions, we kind of figure out the right product match for our clients and certainly give you an indication of like what's going on with interest rates and what your buying power looks like based upon the interest rate levels. But we'll kind of figure out what ultimately the right product fit is for you. Now, credit plays a role in our product match, but interest rate offerings. And so as you're preparing for home ownership, I wanted to give you some quick tips around credit to give you some insight on how to create opportunity for you within your credit. Now, every loan program has a minimum credit score, and I've kind of spotlighted a few of these here. We'll talk more about programs in just a second. When we think about credit, there's obviously 3 different agencies that report on credit. So there's Experian, Equifax, and TransUnion. Each one of those agencies produces a separate score. Now, in lending, we always use the middle credit score of all 3 bureaus. So for example, if my highest score is 780, my middle score is 760, but my lowest score is 740, in financing, we're going to use the middle credit score for all 3 agencies. So we'd use the 760 credit score when it comes to qualifying. Now, if my partner is also going to join me in my application, but let's say my partner scores are just a fraction lower. So they're at 740, 720, and 700. Well, their middle score is 720. So in lending, we always take the lowest middle credit score between both borrowers. So that's important to understand. So if you do decide to apply jointly, we're going to look at the 720 score, which could impact your interest rate, your product offering, maybe even the cost of mortgage insurance for your home financing. Some of these topics here we're going to explore here in just a few minutes, like credit utilization. We're going to talk a little bit about account closure. All those things are super important when we think about maximizing credit score. Now, when we have past challenges on our credit, let's say a late payment or hard inquiries or maybe some bigger events like a bankruptcy, this is a matrix that'll kind of give you a guideline for how long those items will stay on your credit report. Now, there are 3 different models to credit scoring. There's auto financing, there's credit card modeling, and then there's also the mortgage model. Now, for those of you that use Credit Karma or some of those tools to kind of just have visibility to your credit score, they generally use the credit card model. If you're looking to try to figure out what your auto financing, your mortgage model looks like, there's other tools out there like Experian offers some upgraded membership that you can see what the different models look like. Of course, as we guide you through the path of home ownership, we're going to kind of show you what the mortgage score looks like. Now, here's the weighting of the score calculation for mortgage. So 15% is going to be how long I've had credit open. So the more mature my credit file is, the higher my credit score could potentially be. 20% is going to be how much new credit am I trying to obtain? So am I opening new accounts or do I have new inquiries on my credit report? That's 20% of the weighting. Now, hard inquiries and soft inquiries are two different things. Now, hard inquiries can have an impact to your score, and you really want to avoid having multiple inquiries, especially in a 6-month period of time. Now, there's two rules in place there's a rule in place for both auto financing and mortgage. So if you apply for auto loans right now on day one, you have a 30-day window of time to apply with as many lenders as you want. And it's the impact of one credit inquiry to your score. Now, in our process in designing home buying plans for our clients, we only start with a soft credit check. And the reason why we do that is because we don't want to impact clients' credit score, especially given our first-time buyers that we work with. They have various cycle times in terms of how long they're considering home ownership. So we want to inform our clients without impacting their scores. And so that's why we start with a soft credit check, which does not have any impact to the score. 30% is going to be around credit utilization, specifically revolving accounts. So we're looking at, like, for example, our credit card balances versus our credit card limits. So if I have $10,000 in credit card limits, but I have a $5,000 balance outstanding, that means I'm at 50% utilization. The optimal level of credit utilization is 10% or lower. So ideally, I want those balances at 1,000 or lower. Now, if I just recently booked another trip on my credit cards and now my balances went from 5,000 to 9,000, right? Now I'm at 90% utilization. That probably had a pretty big hit to my credit score. Our coaching for a client that just did that would be to say, hey, let's go ahead and try to whittle that balance back down below 50%, because that's an improvement line where if I can get to 49% utilization, I'm going to have a much more improved credit score, or 50% utilization. Now, if I can get down to 30%, now I'm going to have another uptick in my credit score, and then ultimately try to get that balance below 10%. Now, to manage down credit card debt, here's one of my tips for you. If you take a look at one of your credit card bills, there'll be two important dates there. There's a statement date, but there's also a due date, right? So the due date is when the payment is due. The statement date is when all the activity from the previous 30 days closes out, and then the credit card issuer sends all that information to the bureaus. So what my tip would be for our class tonight is if you can try to pay down that balance, or pay it off ideally, right, before the end of that closing date for the statement, what you're going to do is lower the outstanding balances, therefore improving your credit utilization and then improving your credit score. So if you can try to get in the habit of paying before the end of the statement date, much better opportunity for your credit score. Last thing is payment history. That's 35%, the largest weighting of the credit score model. Of course, we're looking at late payments, especially in the last 12 to 24 months. They're rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. So the more severe the late payment, bigger impact I'm going to see on my credit score. All right, so when we look at credit and analyze that for our clients' plans for homeownership, we also take a look at student loans. Now, it sounds like most of our student loans, especially the federal student loans, are coming back online for payments in the next 30 to 60 days. Many of those were in forbearance because of the pending litigation, if you will, for student loan forgiveness. And so I know nobody wants to make their student loan payments, but it's actually good news from a financing perspective, because that holdup really created some issues for clients trying to qualify with student loan debt. Because ultimately, if you are on an income-based repayment program now and you go into active repayment in the most recent 30 days, then we can use that minimum payment, whether that's through a savings plan or a graduated student loan payment plan, for your qualifying, which generally will give us the lowest payment. So if I have $75,000 in student loan debt and my income-based repayment amount is $250, then we can use that for qualifying. Now, if I'm still in forbearance or I'm in deferment because I'm back in school, that same $75,000 in debt, I would have to use on an FHA loan 0.5% of the balance, which is $375, or a conventional loan 1%, which is $750. So that could change our buyers qualifying. So ideally, if someone's on an income-based repayment program and they're in active repayment, that's going to give us the lowest outcome and hopefully improve what we call the debt to income ratio, which is expenses versus income. All right. So again, kind of the takeaway here is if you're in forbearance or deferment, we still have to count that minimum payment. But if you're in active repayment, then we can use whatever that payment looks like, especially like an income-based program option. Now, the reason why we have to consider that is because every loan program has underwriting guidelines, and there's some specific guidelines to student loans. Now, in this program segment, we're going to talk a little bit about what some of those programs look like for you, and give you some guidance on which would be maybe a product match for you. The first program we're going to take a look at is the conventional home loan, which is a Fannie Mae or Freddie Mac loan. For first-time buyers, it does have a minimum down payment of 3%, up to a loan amount of $802,650. Now, depending on where you're at in the country, and if you're in California, some markets or most markets are what we call high cost of living markets. So we can stretch that maximum loan amount all the way up to $1.2 million. But when we go beyond 802,650, which is the conforming loan limit, that minimum down payment jumps from 3% to 5% for the buyer. Now, the minimum credit score for the Fannie Mae and Freddie Mac product are 620. And so when we think about the Fannie Mae and Freddie Mac loan, those are probably about 60% of all originations done across the country. So it's obviously it's a popular product. Now, when you look at Fannie Mae and Freddie Mac, they are not government-held agencies. They are still privatized, but they are kind of under conservatorship from the U.S. government, especially coming out of the housing crisis of 2008, 2009. The next product is the FHA loan. That's a Federal Housing Administration loan. It is a government-insured product. Minimum down payment of 3.5%, a little bit lower credit score requirement down to 580. And then the maximum loan amount changes based upon what county we're going to buy in. Now, FHA is a government-insured loan, and there has been some changes this month as it relates to residency for both the FHA and the USDA product, which is another government-insured product. So in order to qualify for those products, you do have to be considered a permanent resident in the United States. So unfortunately, those changes were made to both of those products this month. Now, in terms of the conventional loan, you can still be a non-resident and still have eligibility for financing, but it would have to go under the conventional home loan product. Now, we're going to talk in just a minute about the FHA loan versus conventional loan as it relates to mortgage insurance. But what we find in working with clients is FHA is going to have a lot more flexibility when it comes to underwriting guidelines, because you can see lower credit score requirements, but a little bit more flexibility when it comes to maybe late payments or past like major credit events that a client has had. Next product is the jumbo home loan. Not really designed for a first-time buyer, but it is a resource. It does require a higher down payment of 10 to 15%, usually higher credit score requirements. It's essentially for clients that need more financing that stretches beyond what we can do with more of the conventional home loan product. The VA home loan is going to be for our veterans that have eligibility. The great thing about the VA product is that the zero down payment for the veteran, a lot more flexibility with the underwriting guidelines and a minimum credit score of 620. That zero down payment option can stretch out to a maximum loan amount of almost $5 million. So there's plenty of buying power for a veteran. And then for veterans that are first-time users, there's usually a funding fee, which is 2.3% of the total loan amount. If our veteran has any type of partial disability, then they will probably have an exemption from that funding fee. And then I commented on USDA just briefly, but ultimately USDA is a product that allows buyers to purchase in more rural areas, which provides the benefit of a zero down payment option in those markets. Minimum credit score of 620. The maximum loan amount will just vary a little bit depending on where that property is located. But there's two qualifiers to USDA. We're looking at the location. It has to be defined as rural for USDA. And then we look at the income versus the household, or the income for the total household has to be within the income limits for the program parameters. Okay. So that's kind of a quick look at some of the products. Now, one thing we didn't have included here, we do also have a physician's loan that is eligible for residents, active physicians, dentists, which provides some relief in terms of minimum down payment requirements, but more importantly, from a student loan perspective. So if I'm coming out of medical school with a lot of student loan debt, when we use a physician's loan, it provides a little bit more relief for the client. So if that's something you're interested in, we can talk a little bit more about that in tonight's discussion, but that's certainly an opportunity for those that would qualify for that type of product. Now, let's take a quick look at mortgage insurance, and that we get a lot of questions around that. There's kind of two different segments of mortgage insurance. There's PMI, which is private mortgage insurance, which would be under a conventional loan. There's also MIP, or mortgage insurance premium, that is under FHA. Now, both insurances cover the lender in case of default by the buyer. And so they are expenses that a buyer incurs, and they look a little bit different depending on each product. So under a conventional loan, PMI is based upon your down payment, your credit score, and then how much you finance. So it has a graduated scale based upon those factors. And then we basically create a dollar premium based upon, what the outcome is of each one of those areas. So if I'm at 3% down payment, I have a higher credit score. It might be a little bit less expensive than, let's say, somebody that has a lesser credit score and putting the same amount of down. Now, on a conventional loan, it does have a cancellation option. So when I reach 2 years in my home on that original loan and I have 20 to 22% equity, I can apply to have the mortgage insurance canceled. So if I looked at a loan amount financed of, say, $700,000 and I had a 740 credit score, if I was planning on putting 3% down, my minimum PMI payment would be about $209 per month. So if some of you in tonight's class have already started kind of investigating what home ownership looks like on maybe Redfin or Zillow, if you've used some of those calculators, probably looks a little bit different just because it's not really calibrated to these three factors that we've outlined tonight. Now, on the FHA side, the MIP looks a little bit different. So there's monthly mortgage insurance on FHA. There's also upfront mortgage insurance. So the monthly mortgage insurance is 0.55% of the total loan amount. And then we divide that by 12. And then there's upfront mortgage insurance, which gets added into the total amount financed. Now, different from the conventional loan, the FHA loan does not have a cancellation option with refinancing, with the cancellation of the mortgage insurance. The only way I can exit mortgage insurance is if I refinance out. Now, if we take a look at the same loan amount of $700,000 with the FHA product, the upfront MIP is $12,250, and then the monthly is $320.83. So clearly a big difference from an expense perspective. But as I mentioned in our product segment, we see a lot more flexibility with our FHA product than maybe the conventional loan, because not all of our clients will qualify under conventional. So FHA is another great resource as an entry point to home ownership. All right, so as we look at products, we also have to consider what our income looks like to qualify for those products, right? And so I want to kind of pass along a few things to our class. One is just the general documentation that we need to validate income in the lending process. So you can kind of see that here on screen. And I want to talk through a little bit about some of the employment or income requirements when you're considering home ownership, because a lot of misrepresentation of what's needed when it comes to home financing. So in lending, we do have to verify the last 2 years of history for a client, and that can be last 2 years of education and or income. So I do have to see that someone has that kind of history. So I could have, let's say, as little as 1 month on the job, but let's say I just graduated from UCSB in the fall and I just started my job January 1. Or maybe just last month. As long as I can show my educational background plus that I'm on my job right now, that could be used for qualifying. So we essentially just have to verify 2 years of history. We even have situations where clients have been on their job for 6 months and they're getting ready to transition to another job. We can actually use their future income for the new job, their prospective job, to qualify for their home mortgage. So they don't necessarily have to be on that job for 2 years. Again, we're trying to verify a 2-year history. Now, it looks a little bit different when it comes to qualifying income for self-employed borrowers. So if I'm a 1099 independent contractor or I own my own business, then I have to show 2 years of consistent tax filings to determine what that income looks like. So that would be kind of the difference. Now, we also look at the 2-year rule as it relates to multiple jobs. So if I have a job where I work 30 hours a week and then I transition to another job for another 20 hours a week, since I'm working for multiple employers, we do have to verify that I've been consistently working for both employers for the last 2 years, just so we can demonstrate an ability to be able to handle both roles simultaneously for 2 years. Now, if I have a 40-hour work week job, but maybe I also drive for Uber or Lyft on the weekends, we can certainly still use the Uber and Lyft income, but we do have to show that I've been doing both my 40-hour work week job and the 1099 or Uber Lyft income for 2 years consistently. Now, another scenario that comes up and question from our clients is that, if I'm going to buy in my name, for example, but my partner is contributing to the household expenses or income, right? Can we consider my partner's income even though they're not part of my application? And unfortunately, that isn't the case. We can't use their income unless they're going to apply with you on the loan. Also, if we have room rents that we receive right now, so let's say we're renting a place right now, it's a 3-bedroom, and I collect rents on 2 of the other bedrooms. We can't transition that income into the new house on most products because you're going to be buying as a sole owner. All right. So that's kind of a quick look at income. Now, we also take a look at expenses versus income. And that's pretty important because we look at a calculation called debt to income ratio, which is essentially all of my existing expenses that I have today versus what my pre-tax income looks like. And those expenses also include the new housing budget that I'm going to have. So if I had, let's say, personal loan debts and credit cards and car financing, but I also had my housing finance debt that we're going to be taking on, I want to look at what that looks like as a percentage of my income. So here's an example of the calculation. So we have a principal and interest and taxes and insurance for my new house. If I have PMI on my home, I have HOA expenses. Let's say I'm buying a condo. If that was $2,500 a month, and then I have also personal debts at $500 a month, now I have $3,000 in outgoing expenses versus this client's scenario where we have $8,500 in pre-tax income. So what that calculation tells us is that 35% of our clients' expenses or income is going towards those expenses. Now, when we think about qualifying for a mortgage, the maximum those expenses can be is 45 to 50%. However, there is flexibility in those numbers. We would encourage clients, or not encourage, but we take a look at affordability more so than when we think about building finance for clients. Generally, an affordability level for most clients is going to be around 33 to 36% in debt to income ratio. So we would consider that excellent. But it does depend on each buyer's tolerance level for budget. So when we design our plans for clients, we're really looking at affordability and sustainable options for our clients in homeownership. Last topic before we get into kind of the workflow of buying a house is around down payment for a home purchase. And generally that could be some of the biggest challenges for homeownership. That could push me out 2, 3, maybe 4 years from homeownership. So some of us are financially ready and we have our down payment saved. Some of us need to create a savings plan. And we'll talk a little bit about that in just a second. But before we do, I just want to explain some of the documents that we generally validate in the lending process. That would include looking at the last 60 days of bank records, like checking and savings account, if that's where our assets live for our home purchase. You can use 401ks and 403bs. That's essentially where you're taking out a loan against those investments in order to put towards your home purchase. You're generally taking out a loan against your own asset and then paying it back through your payroll. We would encourage you, before you access 401ks, 403bs, even brokerage accounts, talk to your tax or financial advisor, make sure that's going to be a great financial decision, but it can certainly be used in financing. Now, gift funds are also an option where a family member has contributed resources to you in your home purchase. Now, all assets require a 60-day seasoning period. However, gift funds do not. So if the donor is going to contribute, let's say $50,000 towards your home purchase, they can do that, and there is no seasoning requirement. There's just some documentation that we have to go through. Okay, so that gives you a little bit of a backdrop to what it looks like from a savings or down payment perspective. Now, as we're thinking about savings for homeownership, again, it's probably one of the biggest challenges for most of our clients that attend classes just like this. So we want to provide you a really simple approach to what a savings plan could be for you. So if we're looking at a total rent today of say $2,000 a month, but let's say I think I can project out for paying about $3,500 in my mortgage, but I just am not there from a savings perspective. What I would encourage our client to do is to start saving today like I'm actually making that $3,500 mortgage payment. So as I pay my landlord $2,000 a month, we create that habit of taking that additional $1,500 that will ultimately be part of my mortgage budget, and we transfer that $1,500 to my savings account. After 6 months, I've now grown that savings to $9,000. After 12 months, now I'm at $18,000. So that can make a huge difference in savings for homeownership. So it not only does that, but also creates the discipline of getting in the habit essentially of that $3,500 mortgage payment. Because let's face it, as we transition to homeownership at some point in time, probably going to be a little bit of a payment shock for us. But if we can create that discipline, there'll be a much smoother transition for us into homeownership. Now, when we look at down payment resources, there are some wonderful down payment assistance programs available here in California and all across the country. Since most of our class is in California, I want to spotlight the CalHFA first-time homebuyer program. CalHFA stands for the California Housing Finance Agency. It's designed to help low to moderate income prospective buyers right here in California. In fact, I've got a chance to help plenty of our Gaucho alumni with these products. It's a great resource for you, for our buyers here in the California market. I want to kind of explain to you a little bit more about what these products can do for you. So the first product is the CalHFA My Home Assistance Program, which essentially provides the minimum down payment of 3% of the price of the home for a conventional loan. If we're going to look at an FHA loan, it's 3.5% of the sales price. That can help substitute what you need as the minimum requirement for your down payment. Now, the nice thing about this assistance is a low interest rate loan that the state is creating for you at a 1% simple interest rate loan. You don't have to pay back that assistance until you either sell your home or if you decide to refinance in the future. Now, for some of our buyers that need even more resources, there's the CalHFA My Access program, which provides up to 2.5% of the loan amount in assistance. It is also a 1% simple interest rate loan, and then it helps to reduce those out-of-pocket expenses like closing costs and prepaid items for a home purchase. There's also the CalHFA ZIP product. Now, ZIP stands for Zero Interest Program. It's a little bit different than My Access. It is 0% interest, but it can elevate the first mortgage pretty significantly. Now, as we look at these different products within CalHFA, there's another big benefit within CalHFA first-time buyer products. Generally, the interest rates on the first mortgages, especially for lower down payment borrowers, will see lower interest rates than what we see in kind of more traditional programs. So if we were to compare a conventional traditional loan versus a conventional CalHFA loan, those interest rates might look a little bit lower. Now, as we stack on more assistance, that interest rate level could rise on the first mortgage with CalHFA. Now, there's some other resources down here, as you can see on screen, like the Pathway program, which is for FHA clients. There's the GSFA program, which stands for the Golden State Finance Authority. That could be an alternative product generally for some of our clients that may not qualify for CalHFA. And then Fannie Mae and Freddie Mac also has closing cost resources or credits, I should say, that will benefit some of our lower income buyers. I want to just walk you through a quick exercise on what CalHFA looks like in a home purchase scenario. So traditionally, if I was to buy, let's say, a $700,000 house and I was putting 3% down as a first-time buyer, not using a first-time buyer program, I would also need to contribute my closing cost out of pocket. So generally, I would probably need about $35,000 to $42,000 to fulfill my home purchase, right? Well, it looks a little bit different on the CalHFA side of it. So if I was to implement, let's say, the My Home Assistance Program, now I would get $21,000 here in assistance that would basically offset my requirement for my down payment. So theoretically, I would just need my closing costs out of pocket for my home purchase. Well, if I need a little bit more resources, we could also incorporate like the ZIP assistance loan or even the My Access program. And essentially, when I put together My Home and ZIP assistance or My Access, I could get over $34,000 to $35,000 in resources to offset what my out-of-pocket expenses look like. So that's really where CalHFA comes in to make homeownership much more of a near-term option for some of our first-time buyers. Now, there are eligibility requirements. There is a minimum credit score of 640 for the FHA product, 680 for the conventional loan. Now, if you're considered low-income housing, that minimum credit score is 660 for the conventional product. Maximum debt-to-income ratio, like we learned about, is 45 to 50%. We look at income a little bit differently on this product than other first-time buyer programs. It is based upon the applicant's income, not the household income. So if I'm going to apply just in my name and my partner is not going to be part of the application, then we're only going to look at my income. And that's really important because that can be the difference in maybe keeping some of our clients within the income limits for the program. The income limits for the program are 150% of the 150% of the median income for the market that you're looking to purchase in. Now, they are set up for just first-time buyers. Now, first-time buyer is someone that hasn't owned a home as a primary residence in the last 3 years. And these are eligible on properties like single-family homes, new construction homes, condos, townhouses, even below market homes can be eligible. So those are communities that have discounted prices for low income buyers. And then manufactured homes that are on permanent foundation can also be potentially eligible. Here's the income limits for some of our markets in Southern California. You can see these noted here on screen. Again, we're looking at just applicant income for that product. CalHFA is a wonderful resource. We're privileged to be the #1 provider of CalHFA in the state. And so we're really well educated on that as a resource. So if that's something you're interested in, we'd love to be able to help build that into your own home buying plan. Well, as we're wrapping up tonight's class, I want to go through our last topic, which is the buying process, which is a really important kind of topic to understand because, where do we go from here after tonight's class? Well, we would love to get connected with you for a consultation to design your own home buying plan to help you on that path towards homeownership. Now, as we get a chance to meet with our clients, the output of that session is going to be pre-approved. And whether you're going to be looking to purchase in 2025 or 2 or 3 years from now, that pre-approval at least gives you kind of more of a baseline for what your qualifying looks like for financing and allows us to set some goals and objectives for homeownership. Now, your application, once you apply, is good for 2 years. So there's no really time constraints on when you need to find that home. But step one starts us with the pre-approval as an output of the consultation. And then we move to step two, which is going to be the home search. Now, some of you may have even started your home search today before class, but you can do a lot of it obviously online. And then as you start identifying homes that maybe fit the criteria that you have in a community and the locate or the structure of a home, then you're going to start your in-person home search. We would encourage you to get connected with a realtor who should be an expert in their market, understand negotiating in their local communities. What are some of the benefits of buying in those local neighborhoods? And we do have a fantastic preferred realtor network. So if you ever need resources, we can certainly get you connected with one of our preferred realtors. Now, as we move through this process, let's say I identify a home I love and I want to submit an offer on that home. Well, that realtor will help you submit that offer. And if that offer gets accepted, then we move to step three. And that's called entering escrow. So that means the seller has accepted our offer. And the same day that offer gets accepted, I'm going to call you and say, congratulations, you did it. You got your offer accepted, which quite honestly can be half of the battle at times. But we're going to have a conversation about what the contract looks like that you've agreed to, set some next steps in place for you, which includes scheduling your follow-up video session where I meet with all of our clients across the country for 30 minutes to make sure that our financing is set up properly and we're hitting all the marks when it comes to your goals for this home. Now, you also have some action items as a buyer once we get to step three, which includes making a earnest money deposit for your home, which is generally 1 to 2% of your purchase price. And that gets added into your total or offsets some of your total out of pocket for your home purchase. Now, that earnest money deposit is generally protected by what we call is the contingencies in contracts here in most parts of the country. That contingency period allows you to do some investigative work. It's usually 17 days in standard contracts in California. It can be shorter depending on how you negotiate with the seller. But in that contingency, we're looking at the appraisal to make sure the appraisal of the home supports the purchase price. We're looking at the inspections that you elect to do as a buyer. And then, of course, we want to make sure your loan gets approved all within that 17-day time period or less. Now, it's important because those contingencies are going to protect that deposit for you so you can confidently go through the process knowing that you're financially still in a safe place. Now, as we continue to move through the milestones, step four is processing and the underwriting of the loan, a lot of the administrative functions like verifying employment, assets, make sure that the income sets up properly for the debt to income ratio calculation. We're preparing everything for underwriting. Now, as we move through these different milestones, you're receiving disclosures about your financing. You get your initial disclosures within 3 days of your accepted contract. And then once we lock in your interest rate, you get another set of disclosures. And then at step 5, you'll get your final closing disclosure, which basically issues you a 3-day cooling off period before we get to the very final milestone. Now, at step 5, we've had your loan approval issued. You probably have your inspections back already. So as long as everything checks out from a loan approval perspective, you feel good about your inspections, your appraisal is good, then you can sign off on the contingency removal for your property, which essentially tells the seller that you're ready to move to the final stages of the closing process. Now, in the closing of the loan, which is the final stage at step 6, you're going to be signing final loan documents in public with a public notary. That process usually takes about an hour to an hour and a half. That is really the only time that you have to sign in-person documents. Everything can be done electronically through our disclosure process. Now, on that same day, you'll also be contributing the final funds for your closing. That will all be kind of gathered by the escrow team, and then we'll also wire in the funds for the financing. The escrow team essentially balances out all the funds to ensure that you've contributed what you're supposed to as a buyer and the seller's receiving the proceeds that they expected as part of the transaction. Once that occurs, then documents get recorded with the county recorder's office. They record a grant deed to transfer ownership to you, as well as the deed for the loan, which of course is the repayment terms of the loan. And once we get confirmation back from the county recorder's office, then we get a chance to celebrate with you because now you become the official owner of the home. It's a great part of our day to be able to celebrate home ownership with our clients because we understand it's a major milestone in your finances. And so we want to obviously be there to celebrate with you. Now, our relationships don't stop after you get the keys to your house. Part of our aftercare program is to stay connected with you. So if things change in the economic climate where it makes sense to refinance, we want to be able to help you with that. We have our rate watch system to notify you when rates make sense to refinance. We have our HomeBot system to track equity position on your home. And we always try to connect with our clients on an annual basis because let's face it, things are always changing financially for our clients. So we want to make sure that we're always here for you as a resource. As we kind of come to our conclusion for tonight's class, if you're thinking about getting connected with us to have your own consultation and design your home buying plan, we'd love to be able to do that for you. It's a really simple process. We call it our Get Started information. You would complete an online application. As I mentioned earlier, we only do a soft credit check. You'll then upload documents and then use our scheduling system to schedule your free video consultation just to make sure you understand what your opportunities look like in homeownership. I get a chance to meet personally with each one of our clients all across the country to help with those home buying plans. It's a really comprehensive plan. Now, if you just have some questions after tonight's class and just want to maybe ask some questions of us, we can get connected with us for an introductory call. We just want to make sure you have all the tools and resources you have when you're ready to start that path towards homeownership. Here's really briefly what that consultation looks like for you. Understanding more about where you want to buy, budgeting for homeownership, maybe creating the savings plan for you, uncovering some credit opportunities, ultimately then getting the product designed for you. So whenever the time is right, you can start your path towards homeownership. I want to point out our resource on mobile. You can start the application process via mobile. You can also follow the progress of your loan through our notification system. But one of the things our clients find really helpful is to use the calculator function, especially as they're out maybe looking around at an open house on a weekend or whatever. Just want to understand, does this particular property fit within our budget? Again, we're really proud of our partnership with the UCSB Alumni Association. We do pass along a $750 discount for your closing costs to create better affordability in your financing design. Again, pre-approvals and our consultations with our clients that we do through our partnerships are just free, no obligation consultations that we do to help guide you on that path towards homeownership. And these classes are always accessible for our alumni community. Now, we do have other partnerships across the country. So if you have friends, family, or maybe even some coworkers that would enjoy this content, they can always check out some of our classes we have. We have a full remaining schedule this year. I think we have over 30 classes remaining on the calendar. Here's all my contact information. So if you'd like to get connected with me after tonight's class, feel free to just send me a message. You can call me directly. We'd love to be able to make sure that we get you all the information you need on your path towards homeownership. And finally, we love what our communities say about us on our social network. Now, you're going to see this video up on our socials on YouTube tomorrow, but check out what our communities say about us because we're really proud of how we support our local communities in affordable homeownership. So you can check us out at Meda Mortgage on both Instagram and in our YouTube channel as well. All right. So that takes us to the end of class. I appreciate everybody being a part of this. I didn't get any questions tonight, but I do want to answer any questions you might have. I know we have a few of you guys hanging in there. Any questions we can answer from our audience? You can use the Q&A function, like I said, or you can use the chat function. I'll make sure I get those answered for you on air. Okay. All right. I hope, since we didn't have any questions, I hope that means we're very thorough. We had a lot of great information for you that you took some great notes on. Again, we recorded tonight's class. We'll have that up on our YouTube channel tomorrow morning. Thank you so much for being a part of tonight's class. We hope that you enjoyed tonight's content, and we look forward to getting connected with you soon to build your own home buying plan on your path towards homeownership. Have a great night.